Welcome to Pi News World, your fastest source for everything Pi Network. From breaking news and updates to events, tips, and collaboration opportunities, we bring it all straight to you. Stay ahead, never miss a beat, and make the most of Pi Network.
Let's dive into the Pi Network, a project that's drawn millions of users from around the globe. With its promise of mobile-based mining, making cryptocurrency accessible to everyone with a smartphone. For years, users tapped their phones, hoping their digital coins would one day be valuable. They envisioned a future where their efforts would pay off, turning their digital assets into real-world wealth. But today, we're focusing on the whales, the massive players whose moves can shake entire markets. These are the individuals or entities with the power to influence the entire ecosystem. In crypto, a whale is someone who holds so much of a coin that their trades can move prices dramatically. Their actions can create ripples that affect every other holder. In Pi Network, one anonymous whale became the largest private holder, second only to the Pi Foundation. This individual amassed a staggering amount of Pi coins, making them a key player in the network. Their presence was seen as a huge vote of confidence, sparking excitement and a sense of security among the community. People believed that if such a significant player was involved, the project must be on the right track. But relying on a single giant is risky, a lesson the Pi community would soon learn. The market's dependence on one major player can lead to instability and uncertainty. This story is a real-time case study in market psychology and the power of concentrated wealth. It shows how the actions of a few can impact the many. We'll break down who this whale was, how they amassed so many coins, and what happened when they stopped. The ripple effects of their actions were felt throughout the network. Understanding this will help you see the real forces behind the price charts and make you a smarter investor. By learning from this case, you can better navigate the volatile world of cryptocurrency. The Pi whale's story exploded onto the scene in August 2025, capturing the attention of the entire crypto world almost overnight. News outlets and social media buzzed with speculation about the identity and motives of this mysterious investor, as rumors swirled about what might come next. Suddenly, a brand new wallet began making massive purchases, buying up millions of Pi coins in rapid succession. Within days, this wallet had amassed over 331 million Pi, an astonishing sum worth $140 million at the time. The sheer scale of these transactions sent shockwaves through the market, leaving traders and analysts scrambling to make sense of it all. The whale didn't just buy and hold on an exchange. Instead, they moved their coins from the OKX exchange to a private wallet, a move that signaled serious long-term intentions. This wasn't a quick flip. This was a calculated bet on Pi's future. In just 12 days, the whale continued their buying spree, snapping up over 7.4 million more coins. This relentless accumulation fueled a dramatic surge in Pi's price, as excitement and speculation reached a fever pitch. By mid-September, the whale's wallet had ballooned to 371 million Pi, making them the largest non-foundation holder by a wide margin. Their holdings dwarfed those of most other investors, cementing their status as a true market mover. This aggressive, almost fearless buying spree was seen as the ultimate bullish signal. It drew in a wave of new investors, all eager to follow in the whale's footsteps and hoping to catch the next big rally. Analysts everywhere began speculating. If Pi's price reached just 2.66, this mysterious whale could become a billionaire overnight. The possibility of such a windfall only added fuel to the fire. The market soared to new heights, with retail investors piling in, desperate not to miss out on what looked like a once-in-a-lifetime opportunity. The excitement was palpable, and Pi became the talk of the town. The whale's bold actions alone propped up Pi's value and created a powerful narrative of confidence and possibility. For many, it was proof that Pi had finally arrived as a major player in the crypto world. For a brief, electrifying moment, it truly seemed like the sky was the limit. thanks to one mysterious investor whose bold moves changed everything. Then, just as quickly as it began, the whale's buying spree stopped. By early October 2025, the last big transfer was made. And then, silence. Without the whale's support, Pi's price collapsed, dropping over 90% from its February peak. Market cap fell from $20 billion to just $2 billion. The price, once at 0.34, threatened to fall below $10. The whale's inaction became the main cause of the crash, showing how fragile a market can be when it relies on one player. Investors who followed the whale now faced panic and uncertainty. The leader had stopped running, and the party was over. The painful hangover had just begun. The whale's disappearance triggered a crisis of confidence across the Pi network. Bullish sentiment turned to fear and doubt, and trading volume plummeted. With buyers scared and sellers trapped, liquidity dried up, making the market even more volatile. A lackluster presentation by Pi's co-founder at Token 2049 failed to restore faith. The leadership's weakness, combined with the whale's exit, created a perfect storm of negativity. Meanwhile, the broader crypto market was shifting. Investors were moving away from hype and towards coins with real utility. Pi, still in its pre-utility phase, was left behind. The whale's exit underscored this shift. Speculation was out, utility was in. The community was left questioning the project's true value. So why did the whale stop buying? Maybe they hit their target, 383 million Pi, and decided to hold. Or perhaps it was a calculated move, pump the price, pause, and wait for a better entry. More concerning, the whale might have lost confidence after seeing weak leadership or looming risks, like the upcoming token unlocks in 2026. They could have spotted a better opportunity elsewhere, or their risk tolerance changed. Whether it was a single investor or a group, their silence is a reminder. You never know a whale's true motives. The lesson? Don't assume big players are in it for the long haul. Their exit can change everything. Before the crash, Pi holders dreamed of Tier 1 exchange listings, Binance, Coinbase, and more. These listings never came, leaving the project isolated and limiting its growth. Technical analysts pointed to bullish chart patterns, but these failed once the whale stopped buying. The price broke down through all support levels, invalidating the optimistic forecasts. The lesson? Technical analysis isn't foolproof. Major events can override any chart. The community's hopes were dashed, and confidence eroded further. Without real progress or listings, Pi's bullish dreams faded. The market learned that hype and hope aren't enough. Fundamentals and real adoption matter most. The Pi whale saga played out as the crypto market matured. Investors were shifting from hype to real-world utility, demanding clear business models and use cases. Projects like Remitix, focused on global payments, gained traction by solving real problems. Remitix raised over $22 million and secured exchange listings, offering tangible value. In contrast, Pi's utility remained undefined, its value driven by speculation and whale activity. The market's evolution showed that sustainable projects are those integrated into the real economy. The smart money was moving to utility-driven coins. The whale's exit may have been part of this broader shift. The message, real-world use beats speculation every time. With the whale gone, Pi Network faces a tough road. Its massive community is impressive, but not enough to sustain value. The looming 2026 token unlocks threaten to flood the market and depress prices. The project must urgently deliver real utility, actual use cases, developer adoption, and business partnerships. Without this, Pi risks being just another collectible token. Leadership must restore faith with a clear roadmap and secure major exchange listings. The lackluster Token 2049 presentation was a missed chance. Now, the time for promises is over. Delivery is what matters. The whale's exit is a wake-up call for the entire project. What can investors learn from the Pi whale saga? This story isn't just about one big player making waves. It's a powerful reminder of the risks and realities in the crypto world. Every investor, whether new or experienced, can take away important lessons from what happened. First, never blindly follow a whale. Just because someone has a lot of money or influence doesn't mean their moves are right for you. You don't know their motives or exit plan. They might be acting in their own best interest, not yours, and could leave the market suddenly. Second, know the difference between price and value. A token's price can soar on hype, but that doesn't mean it's truly valuable or sustainable. A high price without real utility is a bubble waiting to burst. Don't get caught up in the excitement and forget to look for real-world use cases. Third, beware of concentration risk. When too much power or too many tokens are held by a few, the market can be easily manipulated. When a few wallets control most of a token, the project isn't truly decentralized. This can lead to sudden price swings and instability. Always check token distribution before investing. Look for transparency and fairness in how tokens are allocated. Finally, have an exit strategy and manage your risk. Set clear goals, know when you'll take profits or cut losses, and stick to your plan. Don't let FOMO or greed cloud your judgment. Emotional decisions can lead to costly mistakes, especially in fast-moving markets. The Pi whale story is a textbook lesson in crypto market dynamics. It shows how quickly things can change and why you need to stay alert. Be skeptical, do your own research, and never rely solely on hype or rumors. Dig deep into the facts before making any move. And remember, if it seems too good to be true, it probably is. Protect yourself by staying informed and cautious. Stay smart, invest wisely, and always put your financial safety first.